love the channel and find it useful in becoming a happy retiree. Subscribe today. Good morning and welcome back to Money Matters. I mean, there's a lot to talk about here when it comes to planning, when it comes to trying to set us up and our families up for a comfortable retirement. And so much of this applies to, it's not just you and your retirement, it's you and your spouse, it's you and it's really a thought of how much money lasts for the family. And it's not just how much money we can pull out to live in retirement, but is there going to be money left for the next generation? And that's certainly a goal for so many families. And part of the calculus there goes back to how much of your savings can you use? And there's been great debate about this over the years, but the industry standard has been 4%. You can take 4%, ratchet it up for inflation every year, and that every time something gets disjointed in markets, whether the equity market goes bad for a period of time, or the bond market like it is today with low yields, it's constantly in question. Hey, wait a minute, I don't know if that rule works anymore. We need to modify it. And what got me riled up this week is this article that says, hey, forget the 4% rule. New research by Wade Fu, professor at the American College of Financial Services, says, oh, you can only use 3%. The new safe rate of withdrawal is 3%. Well, listen, it's always been 3%. It's, you know what? Do it at 2%. Do it at 0%. You don't run out of money. You've got to have some practicality within these numbers. So I, along with Robert Sanders on part of the Money Matters team, we wanted to bring the Bengen research, this 4% rule research that was published way back in '94, kind of bring it to be to more current and add in many of the years that before he did his study, or bring in all the years since the study was published to try to get a sense of what does this rule look like. And because we're starting to hear, well, it doesn't work anymore. You've got to do 3%. Well, let's go and take a look at what these numbers look like. So we recreated Bengen's work. I wanted to bring it into kind of modern times. Again, he published it in '94, over 20 years ago. So we re-upped the survey, or re-upped the study to include the debacle of 2000 and 2002, that 3-year period. The great financial crisis, 2007, 8, 9, where the markets got completely hammered, at one point down 57% for the S&P 500. Then we used even lower assumptions for stock and bond returns than Bengen did in his original study. And when he ran out of data, because we were trying to get to 50 years of retirement, he had to use he used average rates of returns for stocks and for bonds. So, which during that period of time, and in his study, if you look at the appendix, he used something like 10.3% for his stock returns over time. He used over 5% for his bond returns, 5.2% to be exact, and he used 3% for inflation for the years that he didn't have data. Well, we wanted to be more conservative than that. So we used 4% for stocks and 5% depending on how we ran this. So let's call it 5% average rate of return for stocks. And we looked at 0% for bonds, 1% for bonds, 2% for bonds, which again, I think is more than conservative from where we stand today. And then obviously using actual numbers from 2000, the S&P 500 returns, the 10-year government bond total return, and then CPI for inflation. So the worst case scenarios that we ran, worst case scenarios, money still lasted 38 years. 38 years, which is, again, as much or more than when Bengen ran this. And again, he was using some pretty dire periods of time. He looked at the 1929 to 1931, the Great Depression, total return for common stocks during that period of time, negative 61%. He calls this the Big Dipper from 1937 to 1941, negative 33% over that period of time. He looked at the 1973-1974 period of time, negative 37%. During those periods of time, when stocks were net negative, bonds were positive during that period of time, offsetting some of the negative stock returns. So here's what it looks like. We did this again at the end, starting in the end of 1999. And then we hit in 2000, 01, 02, when the S&P 500 was down 9%, then 12%, then 22% in the 3 years in a row. So let's imagine you retire in January 1, 2000. Then the first 3 years you're in retirement, the market goes down and then down and then down. Then if we model past 2017, because that's when we have actual data for, then we assume that stock returns were only 5%, bond returns only 1%, and inflation at 3%. From our calculations, you can still use the 4% rule, and again, using 3% for inflation, and money still lasts 41 years. So at age 60, if you modeled it out this way, you'd run out of money by the time you were 101. Again, using 5% rate of return for stocks once we use up the data that we have. Again, we have data for the first 17 years of the study, and then we've got to use some sort of assumed rate of return. We're using really conservative numbers here. 5% for the stock market and 1% average rate of return for the bond market. Let's look at it in 2007, recreating these numbers. Well, again, we have actual returns from 07 to 17, and then using 5% for stocks, 1% for bonds. And this is where we changed this up a little bit and said, well, after the first 18 or 17 year, or after the first 10 years of retirement, we stopped ratcheting up for inflation. So we said, okay, well, we're going to still spend the same amount of money each year. In that scenario, money lasted 77 years. Now, if you take it if you change that to 3% inflation, that money still lasts 39 years. Spending went, and by the way, think about inflation, what this does to your spending. If you start out with $40,000 in spending, so 4% of $1 million, by the time you're in year 39, if you ratchet it up by 3% every year, for inflation after the first 10 years of actual inflation data, you're spending almost you're spending $107,000 a year. Next iteration, we started the year end 1999, so 2000, the beginning of this withdrawal period, and changed our withdrawal rate to 5%. Again, using actual inflation, and then starting after 18 years, so after 2017, using 0% for inflation, money still lasted 33 years. And that's looking at one of the worst decades in modern history when it comes to stocks, still lasting 33 years, assuming that moving past the year 2018, we're at 5% in stocks, 1% in bonds. So there's a lot to be said for this. So from what I'm seeing here, Bengen's study still works. And then we have different iterations of it. And that's what I want to talk about when money matters returns. Well, I want to wrap this up as we're talking about this withdrawal rate. We talked about we brought current Bengen's research. I still think that his 4% rule makes a lot of sense. I don't think that the article in the Wall Street Journal with new studies from some sort of professor named Wade Fu, I don't think that makes sense. I don't like their assumptions. I think 3% effectively kind of just puts people out of the game. It's just not enough. And the bottom line here is that these ultra long-term studies are only guides. And they have to help, you have to find an appropriate range or target. So it's whether it's 4% with inflation, 5% without, or only using half inflation, they both get us there. And they both get us to the point where we're not running out of money. In the vast majority of time period. So if we experience extremes, though, we have to be willing to adapt or change. We're going to update our spending. Bad year for stocks, spend less. So we've got to look at it as a dynamic approach, a dynamic outlook, a flexible budget, so that we don't just look at this as a constant rule of thumb, because the world changes and we've got to be able to do and adapt the same. Hi, I'm Wes Moss, and thanks for taking a minute to hear about what's so different about my new book, You Can Retire Sooner Than You Think. So unlike other retirement books, this book will give you a step-by-step guide, whether you're in your 20s or 30s or 40s or 50s, to learn from what these successful and happy retirees did to get there. I hope you enjoy the book, but more importantly, I know that it'll help you retire sooner than you think.